Welcome to the podcast. My name is Taylor Avakian, and today I have an incredible, esteemed guest, Chris Tourtellotte. Welcome.
Thank you, sir.
Of
Happy
course.
to be here.
This is going to be fun. So let's just jump into it. Tell me about Snowglobe. How the hell did you start a music festival, Snowglobe? And I know this is a real estate podcast, but you just have to tell me.
I will. It is an interesting story. So rewind to, oh my gosh, this was like 2010, right?
Okay.
I worked at PGIM, which is a subsidiary of Prudential Financial. I was on the equity side, so I was investing in sponsors actually like
that at
us,
college?
JV equity. Yeah, right out of college. I was an analyst.
Oh.
And my friends and I loved music, still do. But we enjoyed going to music festivals and whatever. So I went to lunch with a buddy of mine, and he tells me about a new music festival called Snowball Music Festival in Vail Valley, Colorado. And I'm enthralled. I'm like, this is awesome. I gotta go.
Yeah.
I'm like, but at the time I couldn't justify a cross country party trip to Vail, right? Just thinking about the funds. And so I'm like, how can I get into this music festival for free and get all my buddies in, right? I got to figure that out. So I thought, well, what value can I add, right? It's all about what value you can add. And it became evident that my, primary value add is I could help get the word out. This is a new music festival. I got buddies, and because I went to college, people kind of scattered. I got buddies in different parts of the country. So I determined to make this happen. So I actually put together a business plan that was super professional. And what I did is each market where one of my friends lived, I called them like a street team leader. And I'm like, this person will hand out flyers and promote the event. In exchange, we want, backstage passes for everybody, right? And then so I went to send the business plan to the founder of the festival, but I couldn't find his contact information. Like I couldn't, despite my sleuthing online, like I couldn't track him down. So I went to the website, and at the bottom it had lost and found at snowballmusicfestival.com. So I'm like, I'm just going to send the business plan here. So I just crafted a short, punchy email. Boom, let the business plan rip into the lost and found email.
Oh my gosh.
Festival. It was a first-year festival too. So
Yeah.
I don't even know if this is set up.
Yeah.
Week went by, crickets. Second week, boom, I get an email back. And he goes, hey, like, I've had a lot of inbound inquiries. Sorry for the delay. Like, yours was by far the most professional. Let's get on a call, right?
Wow.
So I'm like, wow. So immediately I put together a website. I create a company, a website that, would at least demonstrate that I had some experience, which I had a little from college. But, it's okay to fake it till you make it.
Yeah.
As long as you do what you say you're going to do.
Yes.
So I did. I put together this website that, presented ourselves as like a concert promotion company. So I got on the call with the guy. I walked him through it. I pitched him, and he's like, great, you're in. We'll do it. So I got the backstage passes. I'm like, this is glorious, right? My friends were super stoked. They had to hand out flyers at the bars and stuff, but we're in our mid-20s,
So like you're not getting paid. You're just getting passes.
Just getting passes. I knew in my mind, though, I wanted to network, right? Because I'm an entrepreneur at heart. So part of it was to network. Like I wanted to meet the guy putting on this amazing festival, like, world-renowned act. So we did what we said we were going to do, right? We promoted the hell out of it, and we flew out to this music festival. We filled up a 747 from LA. We all flew out, and friends from all over the country. It was amazing.
Wow.
Hard to know how much we contributed to that. You never know with marketing what's wasted, what's not. But we did promote the heck out of it. So it was great. Then I got back to San Francisco, back to my day job at PGIM, and I'm working, tired. I'm like, oh my God, like I gotta do this again, right? This was like way too exciting. So then I'm like, well, I got to step my game up. Like I want to be like the co-founder of a music festival. So my buddies and I determined that we would put on a festival in South Lake Tahoe. And it was actually going to be in the summer called Independence on the 4th of July weekend. But as we went into it and got into it, we go, we all have full-time jobs. I had a buddy at like Google and Apple, and I was at PGIM, and one guy at Deloitte. We go, this is too much. So then I reached out to the founder of Snowball, who I met. I basically called him and said, hey, look, we should do a festival in South Lake Tahoe. You can be the operating partner. I'll raise the capital. And he was in. So we planned it out over New Year's Eve. It was a 3-day event, the 29th, 30th, and 31st of December in South Lake Tahoe.
Yeah.
Captive audience, because everyone goes to Tahoe and parties, right? They're all in state line, climbing light poles, doing crazy shit.
Yeah.
But we go, we'll have shuttles that go back and forth from state line to the venue. We got a captive audience, thousands of people there. So, we booked an incredible lineup. And I raised the capital. That proved to be very hard, by the way, at age 26, raising capital for a music festival. You've never been in the space.
Yeah.
What I found interesting too in that regard, I worked at PGIM, and so I was good at analytics, and I realized that I could transfer knowledge from one industry to another quite easily. And I think if you can, use that skill in life and in business, right? LeBron James does that. He was a football player, and he's very explosive on the basketball court. Like the lead singer of Beck plays 7 instruments, whatever, like that. It's a similar kind of concept, right?
Yeah.
And so I created this Excel model that was very sophisticated. Ticket sale was equivalent to like, renting apartments. Rent growth was like ticket sale growth. I had operating expenses. NOI was EBITDA, whatever, right? Sensitivity tables, the normal stuff we do.
Yeah.
So I had this awesome Excel model with the inputs, and people could change the inputs and see the results. So anyway, so I put together the business plan, and really I raised a lot of it from my friends' parents.
Okay.
So friends and family, but really family of friends to be more specific.
Yeah.
And we did it. We raised the capital. So I raised the capital. Took a lot of time, and then we put on the event, and it was as we thought, like it went really well. And I had put on some concerts in college that didn't go well.
Yeah.
This went really well, and I got to give credit to like my partner, the snowball guy, because like the operational piece is like very hard. So he gets most of the credit, but it was amazing.
Crazy.
My work was up front, and we had the biggest musical acts in the world, from Tiesto, Cascade, Snoop Dogg, Cut Copy, Rufus Du Sol, whatever, right? So it was like amazing, and every year I had many backstage passes from my friends, and that's where I took my now wife there, and we had the artist would play in our basement after. It was amazing.
And then how did you exit that?
Well, we ran it for many years, and ultimately, by the way, MTV bought it in 2018, which was a big
wow,
which is cool. MTV is obviously a notable cool company.
So was that your first and were you in the negotiations when they were trying to buy that? Like, did you go through the due diligence process?
Yeah, the sale of the festival was an interesting process, and I learned a lot. One kind of funny story that came out of it was when we got to the end. I'm like, hey, we will only sell the festival if I can get 24 artist passes indefinitely. And they came back and they go, well, we have a policy. We have a company policy that we don't provide backstage passes, to founders of festivals when prior founders, when we buy a festival. And I said, oh, that's interesting, because I have a policy. We don't sell music festivals without backstage passes. So it actually became like an issue at the end, which is dumb. Like why that could be an issue.
For sure.
But ultimately we got him for 5 years or whatever.
Let's go.
Yeah. So anyway, so it was fun. It was a really cool experience. I learned a ton. Passion project that ended up, being.
I'll tell you a little funny story. So I don't know if you know this, but I'm from Sacramento. So
cool.
Tahoe is our like vacation spot, and this was the year that Wiz Khalifa was there.
Yeah.
Me and my friends ended up going.
Yeah.
We did not have tickets. And so I'm in high school at this time, 17, 18 years old. And we go there and we're like, all right, we're going to figure it out. Like we'll find some tickets, or a few of us had tickets, a few of us didn't have tickets. One of those situations. So anyways, we get there, the guys who have the tickets get in, and I didn't have a ticket. We're like, okay, maybe we can scalp one. Let's go find some scalpers. They were selling for like 2 or 3 times what the actual price of the ticket was. And we're like, okay, we don't have the money for that. So what we ended up doing was, one of my first negotiations, I guess you could say, is we ended up going to one of the security guards, and we paid him like $150 in cash and just got into the festival.
Oh my gosh.
So so we snuck in, unfortunately, to your festival. So I apologize for not.
I love it. Yeah. No, that's a good thing. Hey, you know what? I'm glad that you attended.
It was amazing. It was incredible. Like,
glad you had
one of the most fun music festivals I've ever been to, which when I heard that you'd started that was like, no way. Like my story when I snuck in, I'm like, I went there. So.
Oh, that's so cool.
Yeah. Really, really cool. Okay. So now let's transition to, you're at PGym, you do the music festival, you're going through there. And then when does LaTerra start? What's the process of you then becoming this development mogul, as I will say?
Well, that's nice of you. It's so in 2000. So I started at PGym in 2008.
Okay,
which makes me feel old. But anyway, so I started in 2008. In 2015, after I'd been at PGym for 7 years, which was, I guess, partly into Snowglobe 4 years. At that juncture, so my dad founded LaTerra in 2009, coming out of the GFC.
Okay.
And at the time, they were buying land from banks. And the banks had foreclosed on land and partially completed homes and townhomes. And so LaTerra was buying that product back, actually, in 2009, 10, 11.
Was it a full syndication? Was he raising money from friends and stuff?
It was both. It started out that way, but he had formed a venture with like a kind of, smaller to middle market private equity group.
Got it.
So it was great. So So I got, at the time I called it the 30-year interview, right, to go work with your dad.
Yeah, exactly.
And no, I'm honored to have that opportunity, obviously. But I did. So I left PGIM, and moved to LA. Took my then girlfriend, now wife, moved down to LA.
What year is
And
this?
this was 2015.
Okay.
Yeah. So I'd been at PGIM 7 years, and when I first got there, I kind of described the business. It was, a little bit of a mom and pop shop, but there was like, I don't know, 7 employees. I can't remember, but they were definitely doing deals, and good platform to step into, obviously. And so at the time, though, we had acquired a deal. My dad had land in Santa Ana, and this will kind of help dovetail into like LaTerra's growth.
Yeah.
And some advice for the listeners too on growth. And so my task was to raise capital for this 228 unit apartment development deal in Santa Ana. It was land at the time. We'd got it entitled. And so I set out to raise the cap stack. I had to raise about 70 million. That was, construction financing,
70 million.
and LP equity. Yeah. And we at LaTerra had never built any apartments, right? I mean, we had done some like actually there was a townhome deal we did.
Okay.
So that's
but
not
nothing
too
of this scale.
Nothing of this scale. And so I went out to raise the capital, right? And I encountered a couple issues, as you can imagine. The first issue I encountered is that the lenders, as I went out for this $40-ish million, construction loan, or 45, the lenders are like, great, you need to put up a balance sheet with 45 million net worth and 4.5 million liquidity, right? Because when you're getting a construction loan, you need 100% of the loan amount as net worth, 10% as liquidity, right? We didn't have that. And so that was issue number one. And how did we solve that? Well, we found a co-GP. And that co-GP would put up the majority of the GP equity, and they would sign on the lender guarantees, right? And so folks can do that, and that's how you do big deals. So we had those two legs of the stool. But there was still a 30 million-ish funding gap, right? To get, or 25 million to get the full capitalization. So I went out to seek LP equity, right? I got the loan, it would go to co-GP. So I'm out, dialing for dollars, trying to find LP equity, had actually engaged a broker, whatever. Got 100 no's. It was extraordinarily frustrating. And we had two issues at the same time, which was the challenge. One, we'd never built a large scale institutional apartment development project, which could be okay. But the second issue was, it was a little bit of a cuspy location. I mean, it was good. It was Santa Ana, but like we're next to a McDonald's and a gas station, and like kind of near Garden Grove. It was just a little transitional. It was vision, but it was a little transitional in nature, right?
Yeah.
And so because we had both of those challenges at once, I think that was what caused us to get 100 no's. And then I went out and finally I got a yes, right? And I was so thrilled. I probably yelled at the guy, in my office next door was probably like, what's going on? I was super excited,
Yeah.
right? Because this is like big time. And so we sign a term sheet, right? Negotiate term sheet, sign it, we're in docs. And then I get an email, and the email says, Chris, we visited the site, we're out. And I'm like, oh my God, it was just so frustrating. And really that's bad form to leave someone at the altar like that
100%.
via email after a signed term sheet.
Yeah.
But notwithstanding that, I was pissed, right? And I kind of like was on the precipice of giving up, but it was like kind of like at that moment where I was like, peering over the edge of defeat, where I was like, no, like screw that. Like I'm going to raise the capital. I'm going to prove this guy wrong. Right. Oh, and because he finished with, and you're never going to be able to raise this capital. I was like, oh my God,
Holy,
so brutal.
Fucking twist.
Yeah, totally. So I was like, I'm going to prove this guy wrong. Right. So then I just went vigilante style. It's going. And randomly I got connected with somebody. He's like, you should talk to this guy. Like they just raised some capital. And I'm like, just whatever, meeting number 206, whatever. Yeah, of course I'll do it. So we have the meeting. He's like, I love this. I like the returns. I like the upside. I like the basis. And I'm like, he's like, we're in. I'm like, you are? You are. Yeah. Well, it was great. So we ended up doing the deal.
Wow.
We did have to raise a pref equity slug. It got a little structured, but we got it done. And we built it for 70 and sold it at TCO for 100, rough numbers. And so that was like, everybody made a bunch of money.
Jeez.
and we were stoked, right? And so that's like a good round. No, timing was good, whatever. But like that's like a good round trip story.
Yeah. Wow.
Yeah. So there's a few lessons obviously embedded in there, right? The co-GP element to that for new sponsors were like, hey, sounds great, Chris, but like, how am I going to do a $70 million deal if the equity's 25 and I got to put in 10% of that, maybe 2.5 on a 90-10 deal? I don't have that, and I don't have a balance sheet. My advice, to the listeners would be, get a co-GP. Like we went on to do another 20 deals with that co-GP approximately.
Wow.
Yeah, and they put up the balance sheet, and the majority of the GP equity, right?
Yeah.
And that's like a normal thing to do. Like there are many co-GPs in the market looking for sponsors even today.
Yeah.
Development's a little tougher today, but like that structure, like it's all good, right?
That worked, and that's what
Yeah.
you. So just so I can understand the timing of this, because I know developments take quite a long time. So 2015, you raised the money in 2015 sometime.
Yeah.
When was the completion? When was the sale?
I think we broke ground early 16 and sold it like in like mid 18 or something.
Okay. In between that time period, were you doing other deals too?
Yeah. So after we synced up with the co-GP and all that, and we got, deal underground, put out the press release, deals beget deals, right?
Yes.
The more deals
The
you do, the more
flywheel
deals you come.
move.
Exactly.
Yeah.
Yeah. So that's the natural order of things. So after we got that deal going, we had the co-GP, we went and we tied up land, these were properties that had by right zoning for residential,
Okay.
like a strip mall in Los Feliz, a car wash in West Hollywood, a strip mall in Mar Vista, Santa Monica.
It was zoned for residential. So
Yeah.
you didn't have to change a bunch of things. It was basically get it entitled and move forward.
Yeah, get it entitled and move forward, right? It's sort of like buying strip malls. Not as many strip mall guy, but I was a mini strip mall guy, right? However, we could pay more than the strip mall buyers because we knew the underlying zoning allowed for high density residential. And so really was downside protection. So at the time I was like, oh, buy a strip mall I'm going to make it up a 4 cap.
Yeah.
It's like, yeah, like, worst case is like you could sell it and maybe get your money back. Like,
Yeah.
whatever, cap rates were lower then.
Yeah. Yeah. But I get what you're saying.
Yeah. Yeah. And so, so we were able to, to compete that way. So we put these properties under contract, sometimes with bridge debt. Don't love that idea today, but did that with our co-GP. And then the idea was we would get these sites into a shovel-ready condition, which included advancing entitlements. They were, we had the zoning, and then bring in LP equity for the vertical stage. This time the locations were really good, right? And we had a deal that was like under construction that was big. So we had kind of solved those 2 issues I mentioned, and we were able to raise LP equity. So from there, we were, we closed joint ventures with big institutional LPs, name brand, household name kind of LPs, and we went on to do like multiple deals that you can, that are up and. Yeah, you could drive, the Charlie, Mar Vista, and
beautiful
Santa Monica,
buildings.
West Hollywood, the
So that all happened within like a 5-year.
Yeah, that was sort of like the 2017, 18, 19 range.
So how many total units did you guys build in that
About
range?
3,000.
3,000 units.
Yeah, so I'll continue the story, which follows like a growth path.
Yeah,
right?
yeah,
The
yeah.
evolution, if you will.
Please.
So after having closed all these JVs, we're like, God, it's such a pain in the ass closing these JVs one at a time with new partners, some repeat. We want like a single source capital partner, right? And we want build to core. Build to core is you build it and then you own it, right? One, because we want to own these beautiful assets. Gosh, put so much time and effort into it. Sell, pay tax. Don't like that. 2, development fees are lumpy, and we wanted to own long term and have some more stability in our fee streams, right? Through asset management fees or cash flow. So that was sort of the genesis of it. And also we wanted to focus on what we do best, right? And not always be raising capital. And so we set out to secure a single source capital partner. And we engaged a great investment bank, and we ended up syncing up with a pension fund, a Canadian pension fund. And it took 6 months, right? And then finally we got a term sheet from this pension fund. And they did a lot of diligence on us and the projects, right? And this is like finally we're in late 2019, we're in JV docs and stuff. And I'm thrilled because this is going to like propel us like to the next level, right? In our sort of growth. I remember talking to my wife in February of 2020, and she's like, is this happening? I'm like, oh, this is happening. And I remember telling her nothing could stand in the way of this deal except war with North Korea. I don't know why I thought that. I guess Kim Jong-un's launching missiles. Right?
Yeah.
Rocket Man, that thing was happening. So, and then COVID hits, and I'm like, oh shit. right? I remember like watching like the Dallas Mavericks game getting canceled.
Yeah.
And at that moment, I was like, uh-oh,
Oh,
we're in trouble.
Jesus.
You know, because we're in JV docs.
Yeah.
And to make it more stressful, we had put under contract a big site in Burbank, right? We're about to open 573 units now, finally.
Yeah.
And we had put up a significant non-refundable deposit, and the option period ended in May of 2020. And this is February of 2020. We had our LP. If we weren't able to secure the LP to close on the land, we would have had to have walked from some significant dollars.
Oh,
so like very meaningful
this is
for
your
us.
guys' own.
Yeah, meaningful for us and our coach EP.
Totally.
Meaningful for us. And so that made it even more like concerning, right? And we actually had another deal we were doing with them too. So we scrambled, and we presented as much information as we could on the health and the viability of our markets and the deals, and why we didn't think like COVID would impact the multifamily sector, and the strength of LA over the global financial crisis, and the way that it rebounded and whatever, right? So we presented all this information, and fortunately our partner proceeded, which was great, good on them, and so we formed the JV.
Let's go.
Yeah. So they committed $250 million in equity, and that commitment allowed us to proceed with the development of 573 units in Burbank, which we did. And now, and we had to entitle it and design it and all that, but now it's finally opening in April. It's pretty cool.
That's amazing.
Yeah.
Oh my goodness, man. I mean, that's the stories. Those are the stories where like any amazing thing you see, you're like, wow, how did someone build that? Or how did they put that up? The backstory and what a lot of people had to go through, there's moments in there where it could have not happened.
Oh, for
Something
sure.
could have gone the other way, and you would have never seen 570 beautiful units in Burbank. Like, it's just the nature of this business. It's and the market shifted, and the timing, and like you couldn't have predicted what happened with interest rates and all this stuff and COVID.
Yeah.
There's so much that goes into it that it's you kind of have to be robust enough to just roll with the punches.
Totally. Yeah. You got to be. That's exactly right. And it's tough. Development is tough. It takes a long time. And so kind of thinking about like, today, well, if you want, I can, do you want me to kind of continue on the final piece of the evolution, please, which is sort of like our self-storage platform?
Yeah. I was going to dive into that. So then you transitioned.
Yeah. So exactly. So in 2021, we had been in communications with an big Australian company, about self-storage. We liked the asset class. It's complementary to residential and synergistic, because a lot of the residents at our residential properties have stuff they wanted to store. We didn't have enough room. We're telling them to go down the street. Some of the entitlement processes, you can either do storage or residential, but like not both. So it doesn't conflict. And also storage follows the rooftops, right? So it's like goes well together. We also wanted to diversify our asset, base, and geographies because COVID had hit by then. It became evident, like urban infill multifamily, like if that's all you're doing, like
all your eggs in one basket.
Right. So we're like, all right, we need to diversify. And we did. And so we diversified by going suburban on our apartments in BTR, but also through storage. And so we formed this JV. We got a $300 million equity commitment after, a lot of work and discussions with them and a white paper that we put together. And we had tied up 3 deals, because seed deals, the best way to secure capital is with a fishing lure, a seed deal. And that's the best way to keep people like moving it on schedule, because you have a live deal, you have a deadline and a closing date.
Yeah.
It's hard to negotiate on a theoretical.
For sure.
So we took some risk again, and we formed this JV and closed on the 3 deals, and then we went on to hire the head of development in the Western U.S. from Public Storage.
Wow.
That was right, because we launched this new storage vertical. We had this capital. We know how to develop, and we had done a lot of work on storage and research, and it's a little easier than multifamily.
Yeah.
But you need a storage expert.
Yeah.
So I actually just went on my LinkedIn and I'm like, who's in storage in the area? Oh, Public Storage is in Glendale. So I actually just slid into his DMs
No
with
way.
a message. Yeah, I just sent a message. We just closed a $300 million equity commitment. The rocket ship's taken off. Like, we want to talk to you about running this storage vertical. And it worked. So he called me back, talked for an hour, went to lunch, and ultimately we brought him on board.
Wow.
I saved the recruiter fee.
Right? You just did it yourself. That social media, man. There's a lot of power in that. Okay, so
that's kind of the evolution. Sorry, that was a lot of talking, but I wanted to give you sort of
no.
2015 to today, mostly.
Yeah. No, that's super helpful. Okay. There's a lot of things that I want to jump into that story. So first of all, you guys you do a big deal out the gate with this apartment in Santa Ana. You raise a ton of money. That works out. How do you get from someone who is doing these small multifamily deals, $1, $2, $3, $5 million, raising family and friends, to someone who wants to go into the institutional space? Like, what is the process of them getting to that level? And ideally, it's raising the capital. Like, how do you do that?
You kind of have to just jump in, and the way to do it is you got to have a deal.
Okay.
So you identify, now, let's say we're talking about development, but it could be, we should come back to why I think today buying existing is a better strategy.
Yeah.
Right now.
Yeah.
It'll change. But yeah, I mean, you tie up a land site. You got to have a deal, right? Because that's the fishing lure that I mentioned.
Mm-hmm.
So you find a deal that's either entitled, or maybe you're going to entitle it, and you put it under contract. And ideally, you have some time for diligence and closing, because you got to go find the money, right?
Mm-hmm.
But you got to have a live deal. And if it's a good deal in a good location, obviously that's,
How much, real quick, how much time do you typically put on your due diligence period and the escrow for things like that?
If there's an entitlement piece to it,
Uh-huh.
right? Like we're processing city approvals, we like to close at the end of entitlements.
Okay.
Yeah, so we'll have
it could be a year.
Yeah. So we'll have like 45, 60 days of DD, whatever it is, put up some hard money, and then have a year, maybe more, to process entitlements and close.
Got it. Okay.
That type of option structure is good, especially if you're taking entitlement risk. And so we typically do that.
That's what you were doing. Okay.
Yeah. Or though, if there's in-place income, you could put a loan on it. Let's say it's a strip mall, or in a little industrial building, whatever it is.
Covered land.
Yeah, covered land play. Put some debt on it, and then your equity check is smaller, right? And then you could figure out how to fill it. That's another way to do it.
Okay.
But like, we don't want to close on just unentitled land. You know what I mean? Like, that's too risky.
Yeah.
Even though like we're even then, like, we're buying land that has the zoning. We're not doing zone changes, but still CEQA. And
yeah, there's a lot of things that can go wrong.
Yeah. So the deal is number one, right? So once you have the deal, like, you have something to put together a book for and go hit it, and then it's just like, you gotta, if you're in a good market with good timing where capital's looking for homes, like, it's a lot easier than obviously a crappy market.
Are you,
like
are you
today.
picking up the phone and like calling? Who are you calling to get these meetings with these capital sources? Like, let's say I'm a broker, right? And I want to start. I found this site and I really like it, and I think you could build 150 units on there. And I'm like, okay, now I got to go raise money. So my first thought is, who do I know that has a bunch of money? Kind of call those people and say, hey, here, I put a deck together. Here's this site. Do you want to invest? But if I'm going big time, I need to get in the rooms with these big honchos.
Yeah.
How do you get in?
Yeah, I think you you hire a capital markets advisor.
Okay.
Capital markets broker.
Okay.
And there are many good ones. I think you're having one on your show, soon.
Yeah.
And so, but there's many good ones. And you hire a capital markets advisor, and they will help you secure the capital. And that could be a co-GP, the construction loan, and the LP equity, the whole stack, right? That's what we had to do in Santa Ana. We engaged a broker. They found us the loan, but not
got it.
Coincidentally, I found the equity. Yeah.
But okay. So brokers are valuable, you're saying?
Oh, they are. Yeah. No question.
Yeah.
They are valuable.
Yeah. Every now and again. Yeah. Did you find the deals through brokers? I'm curious to know. Or did you go and find them yourself?
You hear the term off market.
Yeah.
And that's a gray area. That's not a black or white statement.
Yes.
A lot of them were kind of off market. And I put it in quotes because, it could be like there's a broker and he's dialing for dollars, hustling, calling owners, right? And he finds the owner of this great site, and the owner says, yeah, I might be willing to sell. And then he calls maybe 3 or 4, you know what I mean? Like, is that off market? Yeah,
Yeah.
it is.
Yeah.
And so a lot of it's like that. Like, we have good relationships with brokers in different pockets of, was SoCal, now, the country. And they run around looking for deals, right? It's less like, hey, like, here's a big e-blast of a deal, that we compete on.
Yeah.
That's, we almost never do that. But rarely. So that's kind of how we've done it.
Got it.
Yeah.
And so then you're getting in the rooms, you're pitching the deals, you're raising the money and going through that whole process. It sounds like from me that you're from PGIM, you're pretty analytical in terms of the way that you approach the business.
I am, yeah, and it helped having that experience being on the equity side because I know how to serve deals up to equity. Yeah.
Okay. How do you serve a deal up that resonates with them? What do they care about?
Yeah, I mean, part of it is just presenting it in a professional way. Which is a deck that has, rent comps and sale comps and
like an OM?
An OM basically. But like a sponsor, if you're going to do your own, like, you want to have a good deck, right?
Yeah.
A good Excel model that's like legit, right? Like that's part of it.
Yeah.
And then it's speaking their language. So it's like, really, it's like, if it's development, it's, hey, like, I can build to a 6.5 untrended return on cost on real numbers. And the market cap rate is 5, for example. And that 150 basis point spread, that's what the equity is looking for to justify development. Otherwise, they're just going to buy, an existing
stuff.
Yeah. So like that element of it, to where, like, if you get them on the phone or you're sending an email, to say, like, you can quickly describe the site.
There's 150 bips of spread, right? It's on this corner. Here's where you give them the story.
You give them the story, like the way the way they want to hear it.
Yeah, it's like a broker when we're pitching a deal to an investor.
Same thing.
Except a lot of brokers and what I do, we don't necessarily always include the renovation costs and the capital costs, and so that's a thing that I think it's hard to underwrite that and present that as a marketing materials because people have different costs of what they're going to do.
Yeah.
Maybe someone's going to put $15K, so maybe someone's going to put $30K. So it's hard to justify that, but you have to know your numbers in terms of it's going to cost us this. Here's what our return on cost is going to be. Like that detailed level so that they feel confident and saying, okay, go and execute.
Exactly.
Yeah.
Exactly. Yeah.
Man. Okay. And so you guys kind of blew up 3,000 units, then the self-storage. And then now I was reading, you have the biggest build to rent project in Albuquerque, New Mexico.
Yeah.
In the whole state.
Yeah. And the biggest opportunity zone development in the state of New Mexico and the biggest BTR deal, for sure in Albuquerque.
Wow. Tell me about that.
Yeah. So, BTR, right? Building single family homes and townhomes and renting them out. Like that's an asset class we really like post COVID, right? Millennials are forming households and having kids and they want more space and they got dogs and they want yards. But, and the whole mentality about, home buying has changed. Like, you don't necessarily need or even want a home. Maybe you don't have the down payment. Maybe you want some freedom to move, work remote, whatever, right? So there's a lot of tailwinds for the sector BTR. And we actually, so we flew out to Albuquerque to look at an existing apartment deal, right? Because we buy existing too.
And you wanted to expand out of California. This is when you were like, okay, let's diversify.
And so we went to look at this like 1980s deal in Albuquerque existing. And one of the buildings was like all black on the back and damaged. And as we got closer, I'm like, what is that? She's like, oh, there was a fire, like that building's like partially burned. And I'm like, and it was old and like falling apart, right? I'm like, this deal's not for us.
Yeah.
You know what I mean?
Yeah.
And I go, but BTR would work really well, we think, here. Because it's a little more suburban, right? Do you know any BTR deals? And coincidentally, she says, well, one of my friends entitled this great master plan called The Trails. She goes, you should talk to him because there is, I believe there's some land left. That master plan is in the northwest quadrant of Albuquerque. Average household incomes are, 90 and 95,000 in the 1 and 3 mile ring. Some of the best schools in the state of New Mexico. We knew we liked Albuquerque for, a few reasons. Again, getting into what does equity care about, right? Some of the statistics. The #1 renter income growth for the last couple of years. in the United States, right? So
Wow.
renters are making more money. High occupancy rates, one of the lowest amounts of new supply in the Western United States. Intel Semiconductor, Sandia Labs are there. There's the New Mexico State, film tax credit. So you have Netflix and
The
NBC Universal.
Lobos.
Yeah. So there's all kinds of stuff going on, from a demand standpoint. So we liked it for that reason. And the site was great in the master plan. So yeah, I mean, we put it under contract, right, with a long-term escrow. We knew it was in an op zone, which is good. And we went out to find the equity for the deal.
Is
And
op zone equity easier to raise at this point, or was
yeah,
it easier to raise?
it is. I mean, the thing with smart op zone, most op zone equity, investors like in this case are very smart, and you can't make a bad deal good, but you can make a good deal better. So the deal still has to work on its own.
If it wasn't an op zone.
Yeah. And so, but it has to stand on its own. But this deal did. And so we found the equity in this. This group invested a significant amount of opportunity zone equity into this project. The budget north of 100 million, whatever, right? So it's it's a big equity commitment.
Jeez.
So it's a family office at a Newport Beach, and it's a great project. I mean, I think we'll do really well. We're going vertical now on the townhomes and single family homes, 344 units.
Do you see yourself expanding in that market? How are you looking at the future of LaTerra in terms of the assets? Because we talked about earlier, development is pretty hard right now. It's pretty difficult. Existing apartments are there. You got the self-storage, you got the build-to-rent. How do you see the growth right now, and what's your approach to what's the next move?
Yeah, I mean, I think, you got to be nimble. And what we've, determined is, today you can buy brand new multifamily assets for 20 to 30% below replacement cost, right? Crazy. And so it doesn't make sense to build brand new. Let's say it's City of LA. So you could build brand new in City of LA for $600,000 a door.
Yeah.
And you could buy brand new for $450 a door down the street.
Yeah.
You're gonna buy new, right?
Yeah.
No, that's not categorically true across all submarkets. Only in some, right? There are some submarkets where there isn't any new product, or you could build for cheaper because of the construction design or whatever. But generally, you could buy for below replacement cost. And as a result, our strategy today is develop where it makes sense, where we have a good, well, I'll tell you right now, when does it make sense to develop? I think you got to have four things: a low land basis,
Okay.
a cost-effective design, which to me means above-grade parking, and high rents. And it's hard to have high rents and a cost-effective design because typically high rents are when it's more urban and dense, and so you got to go below grade. Everything's smaller, so you got to have a big site. Hard to do it all, but that it works if you have that. And so other than that, we're buying. We're gonna go out and buy existing multifamily for less than replacement cost, and we're actually raising a fund vehicle to do that. And, and we're doing this one-off.
Yeah.
With kind of the high net worth family office thing, and it's maybe some institutions. So that's kind of the next thing for us.
Okay.
And we're targeting Sunbelt markets, mostly the Western Sunbelt.
Okay. So you're not going in California.
Well, we are. California is one of our markets.
Okay.
Yeah, we found some investors are a little bit, I'd say cold on California, but not all. I mean, honestly, California is some of the best supply demand fundamentals out of anywhere, right?
You can't beat it.
Yeah, and you can't paint California with a broad brush. So City of LA is not as good as, say, the Tri-Cities, Burbank, Glendale, Pasadena, great. Orange County, great. San Diego, great, right? But there are some markets, and then there are parts of LA, it's massive, right? Culver City, great. You know what I mean? So it's sort of, you can't paint it with a broad brush. But no, California's in there. Okay. Yeah, we love California.
Okay.
Still. Yeah.
How are you looking? What's a good deal to you? So because you're a numbers guy, so give me the numbers on how do you determine if a deal is good?
Yeah. So, well, there's a few things. So we pay a lot of attention today to price per pound.
Okay.
And discount to replacement cost. I mean, it matters, right? If you're, and also what did something trade for at peak pricing? These are interesting things to know. But if you can buy for 20 to 30% below replacement cost, that means that you can offer rent significantly less than new construction, right? And so That's part of it. The other thing is like, what's your yield on cost, obviously, your cap rate, right?
Mm-hmm.
Relative to the 10, relative to the cost of debt. Um, I probably care a little bit less about the going in return on cost in as
Okay.
much as I care about like the year 2 or 3 stabilized.
Okay.
And the reason is there's a lot of concessions today. So there's a lot of
Mhm.
noise in the market. And so it's kind of hard to say like, let's say you got 2 months concessions, but that's burning off and demand is
Mhm.
robust and there's no new supply coming online. New starts are down 70%, and they are. So that fast forward to 26, 27, 28 should look pretty good.
Mhm.
And so I'm okay like saying, hey, not with crazy rent growth at all, but like, what's once the concessions burn off and you've kind of come to a more normalized NOI,
Mhm.
in year 2, maybe year 3, but let's say
Mhm.
year 2, is that a high 5s or a 6, relative to the cost of debt? So that's one, and it depends on the market. Like,
Sure.
every market's a
You
little
want to
different.
get 100, 150 basis points above where you think the cap rate is going to be at an exit.
Yeah, yeah, that's a good way to look at it. Although I will say that's more development, like, because development is so much riskier
Mhm.
that you require a bigger, spread
Mhm.
between your stabilized yield on cost and spot cap rates,
Mhm.
to get paid for that risk.
Yes.
If it's a value add deal, the spread's more narrow. If it's like, hey, I'm going to buy a 2020s vintage, Class A apartment deal, let's say in North Dallas, and let's say you think you're going to exit at a 5.5 or 5.25,
Mhm.
cap, I don't know, in year 3, or 5, then you could get to a 6. You know what I mean? Like, so that spread is more narrow
Got it.
because of your risk is so much less.
Got
You're
it.
not going to get like a fat spread by
Yeah.
taking without the risk. Yeah.
Yeah, totally.
Yeah.
Okay.
But still spread profit. Yeah.
Yeah, I mean, we want to make some money. We're in the
Gotta
real
make some
estate.
money, baby. Yeah.
Are you buying 70s, 80s, 90s stuff, or are you just doing newer construction?
It just newer, yeah. So, I mean, we might buy like some, early thousands. Yeah, so
Okay.
that'd be nice. But it's mostly brand new. I mean, this thesis is by, 2020s vintage Class A multifamily. Because we're a developer, we see some really interesting deal flow. That could be other developers calling us saying, hey, like we built this, let's say they built it for 100 and their loan is 60. Now, their new loan to refi, right? They're at the end of their construction loan term. They've extended. It's a beautiful asset. It's built. It's leased. But they go, geez, my new loan is 45 million. And so there's a $15 million equity infusion,
Mhm.
right? Because it's
Mhm.
constrained by debt service coverage,
Yep.
and interest rates are way up. So proceeds are down, values are down. So like the new lender's like, hey, this thing's not worth 100, it's worth 80, and your loan's 45.
Mhm.
So they're selling, right? Or in some cases, lenders are calling us saying, hey, like we provided the construction loan to this borrower. They're a great borrower. We like them. They did a great job, but like we don't think they can take us out. Like you should call them. So seeing some deals kind of like that.
Okay.
So we think there's like a couple years, I don't know how long the window is there.
Yes.
We got a
The
period
next
of time
couple
to go buy
years.
some existing stuff. Yeah.
And be able to make the most of it. It's super interesting because I actually think in Los Angeles, that is the best opportunity as well, because the vintages of the actual yields that you can get from a new construction building versus a 1920s slash 40s, 60s building, it's not as big as people think. Like, it's
Yeah.
not 150 basis points. Maybe it's 75, maybe it's 50 in some instances, depending on the location. So
Yeah.
if you're going to buy a 1960s building versus a 2010 built building, which one would you prefer?
Yeah.
Right? The 2010
2010. Yeah.
built building.
Yeah, you're right. You're right.
Interesting. Okay, so that's the next step over the next couple of years for you guys on that front.
Uh-huh.
When you're raising money from institutions, what do you look for in like a GP and LP partner? Like, what is important in that partnership?
Yeah. Well, we're the GP. I think, it's there's a few things, right? I mean, so let's say like the 4 Fs, right? Fit, are they a good fit, right? Future, could you have a future with them? In other words, will they do, more deals with you? Let's say finance, like what are the terms, right? Are they,
Mhm.
what are the promotes? What are the fees? That stuff matters. And then fun, I call it like the cell phone test or caller ID test. Let's say like, when your equity partner calls you, is that like, oh, sweet, hey, like, good to catch up. You're kind of
Yeah.
happy to talk to them, or is it like, life is short. You want to work with people who you kind of enjoy.
Yeah.
And so, all of those characteristics are important, right? For any LP. I will say that, for this new strategy, like we're with this fund, like we're taking on, individual investments, high net worth, friends and family offices,
Okay.
RIAs, whatever. And so that's for us, that's different, right? That's different than the institutional investors that we've worked with in the past. Just because part of the reason is, it's longer term hold capital typically, but like when you have an institutional LP, they will call all the shots. And why does that matter? Well, if you've closed on an apartment deal with a core funds are open-ended, like they have all these investors, pensions and sovereigns, and they can put money in and pull them out, right? Like you heard the Odyssey Index, open-ended core diversified equity. The big core funds, of which there are many, they are now seeing redemptions, meaning their investors want their money out, right? Pensions and sovereigns. So the big core funds are now trying to satisfy those redemptions. So what happens is you could have a portfolio manager in New York and they go, all right, CalSTRS, whatever, they want 100 million. All right, we're selling this deal, and this deal. And if you're one of those pins on the map, you could be in a recession or a downturn, and all of a sudden they're like, oh, we're selling it, and you have no choice, right? That's not good, right? That hasn't happened to us yet, but it might, who knows, right?
Yeah.
And so that's one example. Or it could be like the fund you're in is a closed-end fund and the life term is up and they got to sell. So there's other reasons
not
they
in
could
control.
Yeah. So that's not as good.
So getting the more family office, long-term capital where, because I mean, many real estate owners and operators that I talk to, they say their biggest mistake was selling, right? Selling specific assets or having to sell. And if they would have just held on to that, one building or that, big land swath that they had or whatever.
Or that
it
Bitcoin.
was. Exactly. That Bitcoin that we talked about earlier.
Yeah.
Agreed. So wanting to get into the more of that patient capital is something you guys have seen value in and wanting to get further into that.
We have, yeah. And it's sort of, I don't want to say reverse evolution, but I mean, today maybe that is the best profile of capital, but like, sometimes a lot of people like start out with friends and family and high net worth family offices, like, and then they're like, oh, like I want to go do an institution so I could do one check and, we're gonna go in the other way.
Yeah. But you see both sides. Like you've been in the institutional space and you're going back to those other things. So that should be a lesson for people, right? Learn from what other really smart people are doing and their experiences, which I want to talk to you about differentiation. And how do you differentiate yourself in a sea of syndicators or real estate investors? Like, what do you think about when you're trying to differentiate?
On the capital raise side?
Capital raise, on the development side, just in general, like how do you have a successful fund that has an investor saying, I want to come invest with you instead of this other person?
All right, there's a lot of people trying to raise capital.
Correct.
I think there's a few things, like, again, having seed deals really helps. So like, we'll put a deal under contract and try to seed it into the fund or just do it one off, having a good deal, I really think helps because then, people can say, this is what I'm underwriting. These are the projected returns, and I like it and it's attractive and they might not have any other deals. So if there's no other deals, that obviously gives you a leg up, or maybe it's better. The other element to it is, just being there's an element, like there's a people person element to it, right? Like, I think people invest with people they like and trust. And people who are, have the experience and track record, like that really relationships. Yeah, that really helps. Ability to execute the way that you present your materials, as I said, like, I think that can really help. And so, I think it's all of it, right?
Yeah.
I mean, sometimes it's like sales, like, my wife's like, what do you do? She knows, but I'm like, oh, I'm in sales. I mean, I'm not, right? But like a lot of like what we do when you're raising capital, right?
You're selling the dream. You're selling the deal.
Yeah, you're selling the deal and you're selling the company and you're selling the vision and the plan, right? Yeah.
What does most of your day look like right now? Like, what do you do
Yeah.
on a day-to-day basis? And I'm always curious because people ask me what I do, and I'm like, oh, I talk to people all day long and see if they want to buy or sell or negotiate deals. Like, what does
Yeah.
your day-to-day look like?
I wake up at 3 and feed my baby. No, I mean, actually, I did that this morning.
You do,
But
okay.
yeah, it was great. But really, it's wake up, work out. Not as jacked as you, by the way, but I'm trying. And get into the office, and I'd say like, I spend maybe a third. So I spend a portion of my time for sure on the self storage
Mhm.
vertical. I like it. Right, we have a
Yeah.
great storage team. I spend time on the multifamily vertical. And so my time, I spend time on both. And I try to spend time, I spend time on all of our assets. But a lot of what I'm doing now is in the capital market side. So it's raising, we may have a new deal. We need a construction loan or
Mhm.
a facility to do a bunch of self-storage developments, or we're refinancing one of our multifamily deals. And, we have a decent team at LaTerra. So,
Yeah.
I have people helping under me, analysts, associates, whatever. But a lot of what I'm doing is closing financings, both debt and then on the equity side, we're always raising capital, whether it's raising
Mhm.
capital for the fund or meeting with RIAs or other institutions, about
Mhm.
potential joint ventures. Like I spend quite a bit of time on that as well.
Yeah.
Yeah.
Okay. So you're because what I've realized too is having really good people on your team is very important in whatever
Yeah.
business that you do. And each person has their own specialization or something that they're really good at. And it sounds like to me that you are very good at that capital money side of the situation. And you're probably obviously good at the numbers too, but you've set it up to where you can focus on that aspect and other people can handle the day-to-day of the construction, the little minute details, the wood's coming in this day. Like, you don't have to worry about any of that on the project. You're making sure
Yeah.
that it's moving forward.
Yeah.
Where are we at this? Okay, great. Let me go worry about raising this capital or working the money.
I think that's correct. We have a head of construction who handles that. We have development people. Um, if there's a problem, you know, people walk into my office.
Yeah.
There's one guy, I love him. He's great. And when he walks into my office, I know there's a problem.
Yeah. Oh,
No, but it's development. There's always a problem.
yeah.
That's the thing about development. I also I do a fair amount of the entitlement work. At a minimum, like I present at the city council hearings and
Got it.
planning commission hearings, or I'll meet with the council office or planning
Mhm.
staff. Like I like to be there.
Yeah.
And so I like to present, at the podium and all that. So I do some of that too. I guess that's more entitlement. But yeah, like a lot of it's like capital raising and relationships and that's right.
What is
Yeah.
your biggest lesson or failure or thing that you've learned throughout the process? Like, is there a moment that didn't go the way you wanted to and you were able to learn from that? Or like, what's been the biggest mishap, I guess you could say?
Other than selling Bitcoin at $200.
Yeah, other
Yeah.
than other
Or
than
making
that.
my wife do it.
Yeah.
There's a lot. I mean, I feel like I'm probably a good, decent developer
Mm-hmm.
because I've already made all the no, not all, but I've made so many mistakes,
Yeah.
right, that I've learned a lot.
Uh-huh.
And I do think that like there's no better way to learn than to just jump in and do it.
Mm-hmm.
So I've made a lot of the mistakes. I'm sure I'll make more. I'm not perfect, but
Mm-hmm.
I've learned from it. I think some of it is like, I wouldn't close on like I'd be weary of debt, like especially like, expensive bridge debt.
Mm.
I wouldn't close on land with bridge debt.
Okay.
We did it. Thank goodness we were able to recapitalize the deals. But it
Yeah.
got hairy, right?
Yeah.
We did it. And sometimes you have to when you start.
Uh-huh.
But use like land options. That's one. Like I don't even like closing on land without like your LP equity in tow.
Mm-hmm.
But closing on land with no LP with a bridge loan, like stuff like that. Like so, you got to be careful on
The risk.
Yeah. So keeping leverage low, especially when things feel good, and it's so much easier just to size up your debt,
Mhm.
sometimes. But like keep your leverage low, right? Like So I think that's a lesson. Just development generally, right? It's like do you really want to go into a 5-year process where costs can rise and the market could be totally different when you're done? And if you don't time it right, like it's quite risky
Mhm.
development, right?
Yeah.
And so, Storage less so because it's faster, easier, less risk, no below grade, whatever. But like at least on the multifamily side, so like part of it is like, just does it even make sense to build multifamily right
Yeah.
now? It's kind of tough, man.
Yeah.
But we're still doing it, but you got to be, selective, about it.
Uh-huh.
And so, there's that piece of it. But I feel like the capital stack structure is probably the biggest.
Got it.
Yeah.
Yeah, structuring it out the gate, and
Yeah.
you do have to experience that at a certain point yourself. But
I will say one other thing, which is don't sign any personal guarantees. I haven't done it. So I can't say I learned from experience. But
Yeah.
like I've seen others do it. And one thing that our rule is no warm bodies. Lenders always say they want a warm body.
Yeah.
We got cold bodies.
Right.
LaTerra.
Yeah.
No, really though, because like you don't want a lender going after your house and stuff,
Keep
and
that separate.
so
It's not
non-recourse,
worth it.
yeah, find a co-GP who could put up an entity, and then as you grow, like you have an entity, and then like a corporate guarantor's fine.
Yeah.
And
And then you're in the
but
in the
be
clear.
careful of the PGs.
Yes.
Yeah,
I've heard many stories and
yeah.
know of them to say that, I don't want to be doing those or having to
No.
do them if I don't have to.
No.
I want to dig into social media a little bit because that's initially how we connected, and then we've obviously crossed paths because we're all in the same circles and whatnot. Tell me about what prompted you to kind of grow that base and how you use social media, or do you use it as a tool? Is it fun for you? Like, give me the little bit of lowdown on that for you.
Yeah, and by the way, I run our LaTerra LinkedIn,
Okay.
obviously my LinkedIn, Twitter, which I need to be more active in, but I find myself busy, right?
Yes.
But no, I find it to be super helpful. And people hate on LinkedIn. I actually like it. It depends. Like LinkedIn's more if you're doing institutional deals and we're dealing with debt, institutional capital. But like, I can't tell you how many times I've gone to a conference or even like walked into a pitch or a meeting with equity. And I sit down and people say, dude, I love your LinkedIn content, man. Or, oh man, LaTerra's so busy. I see all this stuff you guys are doing on LinkedIn. Like these guys are great. Like they're great, and then they have this like predisposition that, they know of you, they're familiar with you, whether it's subliminal or, subconscious or not. Like they've just seen your, projects and they're like, oh, these guys kill it. At least that's the impression, right? And,
Totally.
and hopefully it's true. But, so I find it to be helpful. On the Twitter, X side of things, I think that's probably more helpful for people who are like syndicators and stuff. I might be wrong, but I like it. I mean, I found you. Look, I'm here right now. It's probably through Twitter, was it?
Yeah, I think so.
Yeah. So I got to do a little bit, but I am, kind of active on Twitter, but it's helpful. Both are helpful.
Yeah.
I like it. I manage all of it, and it's a lot.
Yeah, it
Maybe
is a lot.
5% of my time. I'd say 5% of my work time is spent on marketing / social media stuff.
Well, I mean, and that goes back to the capital raising. Like you're marketing yourself, you're marketing the companies, you're marketing the opportunities.
It's important. Yeah.
Getting in the right doors and in the right rooms is so important. If someone right now is listening or watching this and they want to develop or they want to become a big owner and operator, like what would you say would be the best first steps, or what advice would you give them in getting to where you are today?
Yeah, I think it's you got to get in the game. So it's really easy to, kind of look and say, oh gosh, like, how do I do this? Like, it's too difficult. Like, I don't have the relationships, or I can't do it, or I work at a corporate job and I'm comfy and I don't want to take the risk. You kind of just have to throw yourself in the game. Because once you're in the game, you can, you scramble and you kind of figure it out. So step one is just, jump in and just get in the game,
Yeah.
You don't just watch from the sidelines.
You gotta get in.
Get in there. And so that's the advice. And, easier said than done, obviously. But, and then it's sort of like try to get a deal under contract, put some capital together, get a good deal, and use that to then raise more capital. And it could be a medium deal. It doesn't have to be massive. And again, the co-GP thing, find a good co-GP, like spend time on that. Find a co-GP that can put up their balance sheet for guarantees and that can put up a large portion of the GP equity. Don't give away too much of the fees because you're going to need that to hire people and pay, your staff, right? Because salaries and overhead are real. So I think the it's important to negotiate that appropriately. You'll end up giving up some of the promote, and find it if you're doing development. Make sure that you have a co-GP that will share in cost overruns should they occur. And if you're finding an LP, make sure that you negotiate the JV docs in such a way that they participate in interest expense or unknown subsurface conditions or other costs that are outside the developer's control, mechanical error versus pilot error. So try to shift the risk off yourself as much as you can, even at the cost of giving up some of the ups.
Yeah.
You know, and just get after it, really.
One other question I'm curious about, because it's not as spoken about, and again, you don't have to go into super big details here, but I'm just curious, like, what is the typical fee structure that you guys try to structure when you are doing these deals? Because I know it's, you know, you have overhead, there's things involved. People, do I take an acquisition fee? Do I have my asset management fee? Do I have a disposition fee? There's a bunch of fees that you can tack on, and obviously it affects the returns, but what have you found to be the ideal fee structure?
Different answer for development versus buying existing.
Okay.
So, you know, development, like there's kind of market rate, like 3% development fee, like, you know, of the total cost,
Yeah.
4% of hard and soft. You know, it's pretty kind of straight down the fairway. If you have, we have an in-house general contractor now. We had to start that because GCs are so tough. But there, you know, so that's kind of a pretty known, like, what's a market rate GC fee.
Yeah.
Asset management fee. So you could spend a lot of time like on the asset management function, and it's very important. If you're going to own an asset, like a build to core venture, you build it and you own it, then you want to try to structure an asset management fee, because like you or your people are going to spend time on it, and there's reporting and there's insurance and there's accounting and tax, and then there's overseeing the property manager. Like, this is people, you know. So I think a market rate asset management fee is appropriate. Now, when you're buying an existing asset, like 200 units in Dallas or whatever it is, you know, it's a 1-point AC fee is kind of normal, right? Because you're going to have acquisitions guys, and they're going to want a bonus, you know, so like you have people to pay, right?
Yeah.
And so an AC fee is normal. And then like an asset management fee, whether it's 2% of EGI or, you know, a percentage of, you know, much smaller percentage of gross asset value or whatever it is, like, you know, that's I think appropriate, right? We don't do like disposition fees, you know, or financing fees. We haven't in the past.
Yeah.
You know, so our fees, we think that there's like we think fees can be like kind of market and customary, and we try to stay within that box.
Got it. So
Yeah.
everyone feels like they're
But people like
fair shake.
Yeah, but we do have to remind people, whether it's like our institutional LPs or anybody, that it's really not a profit center. You know, people think it is.
Yeah.
Unless like maybe if you're taking a big AC fee rip of 2 or 3%, or you're rolling that into the deal, like maybe, but like generally speaking, like, you got to hire people and pay them, and insurance and rent and overhead.
Keeps the lights on.
You got to, you know?
Yeah.
And it ebbs and flows too.
Yeah.
Yeah.
Absolutely.
You can't, actually I went to, when our fees, you know, were a little light, I went to Whole Foods and I was buying all these groceries, and I went to check out, and she, you know, that'll be $236. And I said, can I pay with my promote? Didn't work. Didn't work, man. So you got fees.
That's funny.
Yeah.
That's so good. I got to use that. That's
And it's not a true story, but it's the point across.
I love that. I love the parable.
Yeah.
Chris, anything you want to leave the listeners, viewers, before we wrap up? This has been incredible, and I hope people came away learning a bunch about development and the intricacies, because you guys have done it honestly pretty incredible since 2015 to grow this portfolio as massive as you guys are. Is there anything you want to leave the people with?
Yeah, thank you. I think it's just, as I said, like, you know, jump in and get after it, because I think when you're put into the situation where you have to perform, that's when you can really rise to the occasion and really, really drive yourself to your full potential, and you'll find that full potential only by getting in and doing it, right? I'm a resource. If people want to reach out to me, you know, send me whatever DM and
LinkedIn. You're on LinkedIn.
No, I'm on Twitter too. X, you know.
Yeah. All the above.
All the above. Yeah. So if
and you're raising some money too. So if you want to do any LP investments,
yes, sir. Hit me up.
We're doing that too.
Yeah.
Chris, thank you very much for being here, man.
Thank you.
Appreciate
it. Yep.
Of course.
Mm-hmm.